Welcome to vTalkInsight, Risk Sentiment Daily for February 16, 2026. AI disruption, a sharp defensive rotation, and pivotal inflation data are colliding, leaving risk sentiment nervous and highly selective. Risk sentiment today is defensive and volatile, with equity markets whipsawed by AI-driven sell-offs and unusually sharp sector rotations. Headline indices like the S&P 500 are hovering near recent highs, but under the surface, there have been large drawdowns in mega-cap technology and outsized moves in AI-exposed sectors. Volatility has surged, with markets described as manic and price action dominated by single-stock shocks rather than steady macro themes. Around a third of S&P 500 constituents are sitting at 8-week highs, while a notable share are at 8-week lows, underscoring extreme dispersion and fragile liquidity. Algorithmic trading, stop-loss triggers, and forced deleveraging are amplifying intraday swings, while ETF flows and retail participation show limited buy-the-dip appetite, pointing to fragile confidence. Against that backdrop, investors are heading into the January CPI release with elevated nerves, as a reading above roughly 0.4% is seen as a potential trigger for renewed equity selling and a jump in yields. Longer-dated treasuries have attracted steady demand despite strong economic data, reflecting both a flight to safety and concern that growth could eventually crack under higher-for-longer policy. Compared with the already cautious tone late last week, today's setup feels more dominated by AI disruption fears and volatility, even though structural supports around AI investment, disinflation, and global growth remain in place. AI disruption and tech-led drawdown are the dominant bearish forces right now. Large technology and AI-linked names have seen sharp corrections, with over $500 billion in market value wiped from a handful of mega-caps in a single day, and individual stocks like Amazon and Apple suffering double-digit declines from recent peaks. These moves are not confined to U.S. big tech. Asian equity benchmarks have rolled over after strong AI-led rallies, and sector indices, such as trucking, have slumped on the back of AI-enabled logistics announcements. Investors are increasingly selling companies perceived as vulnerable to automation, from logistics and travel to online gaming platforms, even when earnings are solid, as seen in names like DraftKings and Expedia. The market narrative has shifted from broad AI enthusiasm to demanding clear evidence of productivity gains and return on investment. High valuation, asset-light business models face particular pressure as AI intensifies competition and compresses margins, while leadership is rotating toward firms with tangible assets and clearer pricing power. If current volatility in AI and software extends to the semiconductor complex, which is heavily weighted in major indices, the broader market could become more vulnerable, so investors are watching for any cracks in that earnings engine. Running alongside the tech drawdown is a powerful defensive rotation and flight to safety. Flows show investors exiting banks and high-beta technology in favor of consumer staples and other real asset-heavy names, with staples outperforming the broader market by around 16% year-to-date, a pattern rarely seen outside deep equity drawdown years. Safe haven demand is also evident in fixed income and precious metals. Long-dated treasuries and high-quality corporate bonds continue to see strong end-user demand, including record participation in a recent 30-year auction, while bull flattening of yield curves in the U.S. and Japan points to persistent appetite for duration. Structural demand for gold remains firm as reserve managers diversify away from treasuries and geopolitical uncertainty stays elevated. At the same time, leverage looks concentrated in speculative pockets, such as leveraged ETFs, crypto, and parts of the precious metals complex, increasing the risk of forced deleveraging if volatility intensifies. For multi-asset portfolios, the message from price action is clear. Investors are paying up for predictable income streams and perceived defensiveness, while treating cyclical and growth exposures far more tactically. Any easing in AI-related stress or a benign inflation print could see some of this rotation reverse, but for now the balance of flows still points toward caution. Inflation upside risk and the potential for a yield shock are another key bearish anchor. Tariffs on steel and aluminum have been filtering through to end consumers, lifting input costs as inventory buffers run down and raising concern that core goods inflation could re-accelerate. Some analysis suggests official CPI may be understating true price pressures, particularly in housing, childcare, and healthcare, with underlying inflation closer to 3%. The January CPI report is therefore seen as a major volatility catalyst. A reading above about 0.4% could trigger a sharp move higher in Treasury yields, especially around the 10-year sector, where current pricing does not fully reflect the risk of renewed inflation pressure. Equity markets that have been relying on early and aggressive rate cuts would likely face renewed headwinds in that scenario. Complicating matters, trade policy remains in flux. There is talk of rolling back some metals tariffs to ease consumer burdens ahead of elections, but timelines and scope are uncertain, keeping commodity and manufacturing sectors volatile. Against this backdrop, positioning that is long duration or heavily tilted to growth assets could be vulnerable to an upside inflation surprise, even as other indicators point toward disinflation over the medium term. On the bullish side, AI capex and earnings resilience remain powerful supports for risk assets. Estimates from major houses point to robust U.S. growth this year, with fiscal stimulus and a surge in AI-related capital investment acting as key tailwinds for economic activity. Semiconductor and infrastructure vendors at the heart of the AI build-out are still delivering strong numbers. Companies like Applied Materials and Arista have issued upbeat sales forecasts well above expectations, highlighting robust demand for memory chips, high-bandwidth networking, and manufacturing equipment tied to AI computing. AI-focused semiconductor names are viewed as attractive, combining solid earnings growth, upward revisions, and valuations that look reasonable relative to their growth profiles. Beyond core hardware, corporates across sectors are embedding AI to drive efficiency and revenue. Examples range from travel platforms like Airbnb using AI chatbots to boost conversion and service efficiency, to large retailers deploying AI across their supply chains to support margins. There are legitimate concerns about rising chip and electricity costs and whether all capex will earn its keep, but for now, the earnings evidence around core AI infrastructure remains a key anchor for constructive growth expectations. Disinflation and prospective Fed easing form another important bullish counterweight to the current anxiety. Shelter inflation, which has been a stubborn driver of elevated CPI, is now decelerating as rental markets stagnate and tariff-related price pressures in many core goods appear to have largely faded. Recent declines in energy prices further support a trend toward easing headline inflation. Several forecasters expect inflation to move close to the Federal Reserve's 2% target by mid-year, alongside U.S. growth around 2% and stable unemployment, consistent with a soft landing scenario. In this context, some Fed officials and market participants view current policy as somewhat restrictive, opening the door to at least a couple of rate cuts if the disinflation path holds. Recent monetary easing dynamics are already visible in markets, with a weaker dollar, a steeper curve relative to last year, and renewed leadership from small caps, value, cyclicals, and international equities. If upcoming inflation data come in on the benign side, it would reinforce expectations for a more accommodative stance and could help stabilize risk sentiment after the recent AI-driven volatility. The key risk is that upside inflation surprises delay or dilute this easing path, which is why every CPI print is being treated as a potential inflection point. Global rotation and growth resilience round out the main bullish drivers. Non-U.S. equity markets, particularly in Asia and Latin America, are significantly outperforming U.S. benchmarks year-to-date, helped by strength in AI supply chain firms and more attractive valuations. Recent price action suggests global equities are decoupling somewhat from U.S. index swings as investors focus more on regional fundamentals. Within the U.S., leadership has also broadened beyond the largest technology names. Equal-weighted indices, small caps, cyclical sectors, and regional banks are all participating in gains, consistent with optimism about robust U.S. growth into 2026 and evidence of rising corporate capex, factory construction, and manufacturing employment. Higher tax refunds and strong private job creation are adding near-term support to consumption, especially for lower-income households. Capital is also rotating through credit and private markets in a way that supports risk-taking. Demand for new corporate bond issuance remains strong with tight spreads. IPO activity is expected to pick up, and global managers are actively targeting large pools of savings, such as Japanese household cash, for new investment products. While geopolitical and deglobalization risks remain significant, the combination of resilient growth data and diversified leadership suggests that risk assets still have meaningful support away from the most crowded U.S. tech exposures. To sum up, today's risk backdrop is defensive and volatile. AI disruption and tech-led drawdowns, a strong flight to safety, and the risk of an upside inflation surprise are all weighing on confidence. Set against that, resilient AI capex and earnings, tangible disinflation progress with the prospect of Fed easing, and a broadening global rotation anchored in solid growth are keeping the outlook two-way rather than outright bearish. Watch the incoming CPI data, the behavior of AI and semiconductor leaders, and whether defensive flows into bonds and staples start to reverse or intensify from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.